please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to the CNBC TV18 special Market Masters. My guest today is Mohnish Pabrai, the founder and managing partner of the Pabrai Investment Funds and the founder and CEO of Dhandho Funds. Pabrai shot to fame in June 2007 when he bid $650,100 with Guy Spear for a charity lunch with Warren Buffett. Obviously a huge fan of Buffett, Pabrai says his investment style is copied from Warren Buffett. His book, The Dhandho Investor, the low-risk value method to high returns, highlights his investing style. Another book by Mohnish Pabrai is Mosaic, Perspectives on Investing, where he has distilled the Warren Buffett method of investing. Well, without much ado, Mohnish Pabrai, welcome to this show. Well, first up, the Turkish issues may be ephemeral, may stay with us for a bit. But even without Turkey, do you think many markets, including US and India, are overpriced?
You know, I definitely find US markets mostly either fully priced or overpriced. So we are not finding much in the US. I think in India, still very much a stock pickers market. And I think when you get past the top 100 names, there's a lot of opportunity. I mean, I think you've got to do your work, but still plenty of great businesses run by great leaders and at pretty decent valuations with good runways and such, but you've got to pick your spots.
Okay, good to hear that. But, you know, last time you told us that you're like 95% invested in India and less than 5% is in the US. Has that changed?
Yeah, actually, I think what I mentioned is that we are mostly at that time were invested outside the US, not only in India, but a few other geographies. But as I speak to you today, we have nothing in the US, and we probably have more than half the pie in India, and then we've got a little bit in China, a little bit in Europe. And that's kind of how but you know, it's all bottoms up. You know, we don't have a view that I have to have X% in X geography or anything like that. It's just what shows up and what makes sense. So I think for quite a while, we've been finding stuff in India, but we haven't been finding anything pretty much anywhere else in the world. And so I'm just spending more time digging into companies here, and it's great.
Okay, I do want to know what you're digging into, what kind of companies. But before that, one more global question. Do you worry that global growth can get stymied by the high tariffs that are being imposed in a tit-for-tat war?
Yeah, so we are pretty far away from a war. I think tariff war, you know, you go to like the 30s, Smoot-Hawley and stuff. I think we're nowhere near that world, and I think well before we get anywhere near those points, I think saner minds are going to prevail. So I do believe that in the kind of battle between the US and China, China will eventually blink. And I think that President Trump, I think he has a very valid point that for a very long time, the U.S. has been on the short end, getting the short end of the stick, if you will, and it made sense because the rest of the world had yet to rise. There was all the World War II issues. So a lot of the way the trade is set up today in the world has a lot of kind of historic reasons which don't make sense today. So the United States is seeking a leveler playing field. And I think it's going to get a leveler playing field. I think the probabilities that we're going to end up with any significant impact on global growth because of this, I think is very low. That's the best view I have today. We'll have to wait and watch, and hopefully that'll turn out to be true.
Well, you know, the one Indian sector which is under the ire of President Trump is the Indian IT sector. You see it from that side as well. Do you think Indian IT companies will suffer because of xenophobia in the US, or do you think they will gain because of US growth?
Yeah, I think the US economy is in great shape. I think the IT companies in India face a very significant barrier with the number of H1s that are limited. And that is, there's nothing in the near term on the horizon in terms of Congress and the president agreeing that gives me confidence that will change maybe in the next year or two. Hopefully it does, because I think the US definitely needs to dramatically increase the talent coming into the country. So I think the the Indian IT firms will probably find it more and more attractive to hire a lot more people locally in the US. That is also not easy, but Infosys is trying to do that, and some of the other guys are trying to do that with campus recruiting and so on. So the problem I think Indian IT is going to face is that you have to really have strong capability to do the work in India without that much dependency on having a significant US workforce, which has not been the case historically. Historically, they've had a significant amount of work done on site, but hopefully that will change over time. So they have to adapt, and they also have to adapt in terms of the type of work. So they've always historically done the lower end IT work, and I think they've got to move up the food chain to get the higher margins and get more remote work without people having to be based in the US.
So clearly you're not digging for value in the IT space.
Actually, no. So, I used to be in the IT business. I actually have a tech background, and I always say that I don't invest in tech because I was in it. So generally speaking, I think the IT businesses for me are not that interesting, mainly because I think it's really hard there are two issues. It's hard to project the trajectories, and they're typically not cheap. So I prefer businesses where they're in industries where the rate of change is slow, they've got some dominance in those areas, and the valuations are palatable.
Okay.
And so then it just depends on kind of what we're able to find. And one of the advantages we have in India is that the tailwinds and growth in many areas are a multiple of GDP. And so that bodes really well if we can get things where we're not paying up too much.
Okay, now which are these sectors where the tailwinds of growth are a multiple of the GDP? Would it be, for instance, the consumer goods sector?
Yeah, I mean, I think I don't think I've historically invested much in the consumer goods and FMCGs, and I think in India, generally speaking, the problem there seems to be that, at least from my vantage point, is they're relatively expensive, and especially the well-trodden, well-known names. Like I said, I think the top 100, the Indian market is interesting in the sense that we almost had a very significant correction, or almost a crash, you can say, in the mid-cap and small-cap space, let's say in the last 6-7 months. And we haven't seen that in the larger names. So more and more money, the indices are hitting all-time highs. But a lot of mid-cap and small-cap names are still well below the highs they hit earlier. And so the thing is, there is a herd mentality where a lot of the money is flowing into a small number of names. And there's a relatively decent universe of, let's say, companies that, let's say, under 3,000-4,000 crore market caps, or maybe less than even a couple of thousand crore market caps, which I think have a lot of opportunity and have decent valuation and growth prospects. So for me, that area is a great area to dig into.
Okay, something.
And I think for many investors in India, getting into like an index fund with exposure in that space is a really good way to go.
Oh, well, you know, Mohnish, there are a lot of people who have gotten invested in mid-cap and small-cap funds in 2017, and for them, what you are saying is going to be music to their ears. But which mid-caps, which sectors, which stocks? That question to Mohnish Pabrai in a minute after this break. Welcome back to our CNBC TV18 Special Market Masters. We have been speaking with Mohnish Pabrai, the founder and managing partner of Pabrai Investments and the founder and CEO of Dhandho Funds. Well, Mohnish, before we enter to the break, you were telling us that there's still a lot of value in the mid-cap space, especially after their year-to-date fall. Now, let me start with one of the biggest sectors, finance. It's a broad space now. Banks, non-banks, insurers, mutual funds, and lately, you know, corporate banks are doing very well. Do you like them? What do you like in this space?
Yeah, so you know, one of the big problems with let's say levered financial institutions, banks or NBFCs and so on, is that you have a small sliver of equity, and on top of that you have you know, maybe 5-10 times or more of your capital that is levered. And as long as you don't make mistakes in the lending and have different spreads, it works well. But in general, those are not easy businesses. I think that in some sectors, like I think even the housing finance companies, there's a lot of entrants, new entrants in the field. The barriers to entry are relatively low, and you know, everyone and their brother thinks they can lend. The problem is in collecting, not in lending. And so it's always easy to give the money away. It's a lot harder to collect. So I would have a lot more interest in, for example, an asset manager than a lender, because an asset manager and lender, even though both are in the same space, in one case you've got this recurring revenue you have on a base of assets which is hopefully growing, and you know, your cost can be a fraction of that. And you don't really have the risks of, you know, defaults and NPAs and all of that. So to me, the asset management business, in fact, I have not been able to find an asset manager in India that, you know, both from a valuation and future prospects kind of fits the bill, if you will. Usually they're well recognized as great businesses, and they're premium priced. And but you know, the nature of markets is that they'll vacillate. So at some point, I may get a chance to get into that space, and I would love to, because I think that that sector has nowhere to go but up. And I think the Indian savings historically have gone into real estate and gold, and that is in the past. And so when we look at GDP growth, we look at savings, we looked at tier 3, tier 4 towns, tier 2 towns, and the savings flowing into the equity markets, which is what is happening and will continue to happen. That's a very strong tailwind for a very long period of time.
But do you also include insurance companies in this, you know, asset managers that you're talking about?
No, I think insurance is a different business. And again, insurance, you've got to separate the property casualty from the life insurers. And quite frankly, I haven't done a lot of work on the Indian property. So, you know, historically, the Indian property casualty insurance business used to be purely state controlled. And insurance in general used to be state controlled. So the entrance in the field, you know, if you look at healthcare and these other areas, relatively young histories. And I think one of the problems you have in property casualty insurance is the average property casualty insurer globally is a terrible business. You know, just because you have these fat tail events that show up every 5-10 years, so things look fine for 5 or 10 years, and then you get hit a lot with 1 or 2 bad events. And so you know, it's a sector where I've historically had an interest, but I think it's good to be wary. So I have no investments in insurance, and I'm skeptical whether I can figure out where these companies are 5-10 years from now with any great precision or direction from my perspective. So I think that's
Okay.
insurance is not something I'm spending a lot of time on, if you will.
Okay. Let me come to what you already have. Sometime back, you bought Rain Industries, and you also bought Suntec Realty, right? You still like the real estate space, the Mumbai real estate space?
Yeah, I mean, if you look at a company like Suntec, for example, when we were first buying our first shares, maybe about 16, 17 months ago, we paid about 1/3 the current price. And so the first quarter of 2017 and the second quarter, the first half of 2017, was, in my opinion, a tremendous time to go into, especially Mumbai real estate. And it's worked out quite well. I think those areas have tailwinds for a while. I think in real estate in general, I separate Mumbai from the rest of India because one of the only geographies in India which is land constrained and wall-to-wall people and a very low quality housing stock. In Mumbai, for example, even if you're affluent, you may not be living in a great flat, unfortunately. And so I think in general, specifically Mumbai, where we are landlocked, we have large amounts of population and very limited areas available for development, those are really good traits for real estate companies. And also the thing is that we had a trifecta with demonetization, GST, and RERA. And so 80-90% of the developers are out of business. And so the survivors, there's a handful of survivors, to them will go the spoils. So I think Pabrai Funds, we have a significant exposure in specifically Mumbai real estate, and I'm thrilled about that. I think it is north of 700 crores, and yeah, I think we'll keep that for a long time.
Okay. Well, we have been voted the third more livable city in India. Leave us with what you want to avoid right now. What is your don't like list?
Yeah, so I think one of the things about capitalism is that you don't get paid more for degree of difficulty. So what Buffett and Munger mean by that is that there are some businesses, or most businesses actually, that are really tough businesses because capitalism by its very nature is brutal. And there are other businesses where an idiot can run them, and they just gush cash, and you don't get paid more for going into the difficult business. You actually get paid more for owning the easy business. And so it's a dichotomy in capitalism where one of the things I'm really looking for is what is the quality of the business? Is it a great business which can be run by an idiot and still make money? Or is it a business that has so many competitors and so, I'll give you an example. The typical bank. The typical bank is not a great business. They have to lend out 7 or 10 times the capital they have to make 1% on assets. Okay, so the thing is your 2-3% spreads. So your margin of error is really small. And we've seen what the impact of that margin of error is in all the PSU banks. So you can take the entire banking sector and say, a tough business definitely cannot be run by idiots. Okay, but if you look at a company like Coca-Cola, in its 30-year history or something, at least 50 years it was run by idiots. Okay, 5 decades. I can name, we had time, we named the CEOs, but they couldn't destroy the business. Not only could they not destroy it, it grew like crazy. With decades of poor management, buying film studios, buying shrimp farms in Thailand, and then selling them all at a loss, all those things put together, Coke has been a great investment. And it's been a great investment because the core business is phenomenal and it's easy to run. So I think the trick I've learned is don't do math till the 4th decimal to invest. look for the no-brainers. And that's what the most important thing, more than the checklist, I think, is looking for no-brainers.
Okay. Well, Mohnish Pabrai, it's a pleasure speaking with you. Sometime when we meet next time face-to-face, tell me those businesses that idiots can run and that gush a lot of money. Thank you very much indeed for joining us today.